Have you ever wondered how businesses keep operating while waiting for customers to pay their invoices? Because sometimes companies make sales, but the cash doesn't arrive for weeks or even months. That's where accounts receivable financing comes in. Accounts receivable financing is a way for businesses to borrow money using their unpaid customer invoices as collateral. In simple terms, a company gets cash now based on money it expects to receive later. Think of it as turning unpaid invoices into immediate working cash. Let's break that down. Imagine a business has £50,000 worth of invoices waiting to be paid in 60 days. The company technically earned the money, but it doesn't have the cash yet. Instead of waiting 2 months, the business can approach a lender or finance company. The lender advances a percentage of those invoices upfront, often around 70% to 90%. So if the lender advances 80%, the business could receive £40,000 immediately. Then, when the customers finally pay their invoices, the lender receives the money, deducts fees and interest, and sends the remaining balance back to the business. Now, why would companies do this? Because cash flow is critical. A business may be profitable on paper but still struggle to pay wages, suppliers, or operating costs while waiting for customer payments. Accounts receivable financing helps bridge that gap. Now, there are different ways this financing can be structured. One common method is invoice factoring. With factoring, the finance company often takes control of collecting the invoices directly from customers. Another method is invoice discounting. In this structure, the business usually keeps control of customer collections while still borrowing against the invoices. The overall goal stays the same: unlock cash tied up in unpaid invoices. But here's something important: accounts receivable financing is not free money. The lender charges fees and interest for advancing the cash early, and if customers fail to pay, the business may still remain responsible depending on the agreement structure. A common misunderstanding is thinking this means the business is failing financially. Not necessarily. Even healthy businesses use receivables financing to improve cash flow and operate more efficiently. Another misconception is confusing revenue with cash. A company can have strong sales and still face cash shortages if customers take a long time to pay. So, what's the key takeaway? Accounts receivable financing allows businesses to access cash early by borrowing against unpaid invoices. It improves short-term cash flow and helps companies continue operating while waiting for customer payments. And once you understand this system, you start to see how businesses often rely not just on profit, but on timing and movement of cash.